TIPS yield and this expected inflation. And the expected inflation proxy, let's call it that, has actually been coming down. So the question is, how do these things add up? Well, if this is going to be 2%, hello, everybody. Ed Yardeni here. Thank you for joining me today. I hope you had a good week, a great weekend, relaxed from a week that probably wasn't all that great. We haven't had much fun in the stock market, certainly, or the bond market, especially since August 1st. July was okay for the stock market. We did see the bond yield started to move higher. It actually bottomed at 3.30% in April, and by July it was climbing back up towards 4%. And then at the end of July, we saw the stock market hit its bull market high. We saw the bond yield climbing to close to 4%. And then on August 1st, Fitch Ratings downgraded the U.S. debt from AAA to AA plus. And there's a lot of controversy about that, but I don't know why. Fitch was just bringing to our attention something that we all knew was going on. It just the markets didn't seem to care that much about widening deficits, and the focus was on inflation and Fed policy. But I think the Fitch rating downgrade brought home that we do have a very serious problem with fiscal excesses. Ever since the pandemic, the government has basically been out of control with regards to fiscal excesses, extravaganzas, stimulus. I guess the first round of checks that were sent out back in the spring of 2020, they worked. They worked like a charm to avoid a major economic debacle. And so did, of course, the Fed coming in with all sorts of liquidity and lowering interest rates to zero and QE forever. But that was modern monetary theory at work, and it did work for a very short period of time. But it overstayed its welcome. We certainly saw that with the fiscal policies producing 2 more rounds of relief checks. And then that was followed in 2021 with a whole host of Biden administration spending measures that have, well, they were kind of not all that visible for a little while because revenues really took off. And so the deficit actually shrank. But in the past few months, the deficit's been expanding because revenues had actually soared, I should say. And now revenues have been shrinking over the past 6 months or so. We'll look at that in a minute. But Fitch just kind of brought home and reminded us that there is a problem with profligate fiscal excesses. And the bond market cared about that all of a sudden. In the past, I've argued that I will only care about the deficit when the bond market cares about the deficit. In the past, the bond market's main focus was on actual inflation, expected inflation, and what the Fed was going to do about all that. Supply and demand in the bond market didn't really seem to matter all that much. But here we are in an environment where the bond market is starting to care very much about the supply and demand situation. Everybody's focusing not only on the size of the deficit, but the Congressional Budget Office came out with a 30-year projection in which it came up with some pretty dire kind of numbers if nothing changes. Of course, they said that this is just sort of an outline of how things are going under current law, and current law can be changed to make these numbers more palatable than the CBO came up with, just extrapolating current law. Well, and so there is an issue with supply and demand. And so the question is, how does that relate to inflation and the Fed, monetary policy and fiscal policy, and the resulting inflation? I still think that inflation is moderating and will continue to moderate. We've seen the CPI inflation rate, excluding shelter, come down to 2.0% on a year-over-year basis through July. We've seen the CPI core inflation rate, excluding shelter, down to 2.5% on a year-over-year basis. I think the PCED inflation numbers that we'll get at the end of the month will corroborate what we're seeing in the CPI, that inflation has been moderating, and I think it continues to moderate. But how does that relate to a perception suddenly that supply and demand really need to be considered as well? Well, I think what we can safely say is that bond yields have kind of gotten back to normal, where they were before the financial crisis. 3 to 4%, 4.5% is kind of a much more normal range for the bond market than the kind of near zero yields we saw, not just in short-term rates, but in the bond market itself from 2008 until 2021, let's say. And so far, the stock market seems to be handling that relatively well. Again, we've had this nice bull market since October 12th of last year. We've seen the market rise considerably right through July 31st, but that level may be it for now. And I do think that there's more downside potential in the market given the action in the bond market. Much will, of course, depend on Fed Chairman Powell's speech at Jackson Hole on Friday. There are Fed officials who've been continuing to squawk hawkish and say that the Fed still has a ways to go in terms of bringing inflation down, and that they may need to increase interest rates further. On the other hand, the president of the Federal Reserve Bank of New York, John Williams, recently said that acknowledged that inflation has moderated, and said that if it continues to moderate, the Fed may very well have to consider lowering interest rates next year, simply because from a perspective of real interest rates, if they don't lower nominal short-term rates, then real interest rates will continue to widen and remain not only restrictive, but become more restrictive. And he said to avoid that, the Fed may need to lower nominal interest rates. Now, that sounds like an outlier, but actually it's very consistent with the FOMC's June summary of economic projections, which in fact project that the Fed will be lowering interest rates in 2024 and 2025. Keep in mind, the FOMC has made it very clear that their goal of getting down to 2% is not for this year, it's not for next year, it's for 2025. What they want to see between now and then is evidence that they are continuing to make progress in that direction. And I think there's plenty of evidence in that regard. We know that shelter inflation is going to be coming down quite consistently over the next 6 to 12 months. Every month, I think we're going to see more and more of a slowdown in shelter inflation, which is mostly driven by rent inflation in the CPI. And so I think that the evidence will be there. And if it wasn't for the darn deficit issue, I think the bond market wouldn't be as unsettled as we're seeing it now. Let's take a look at some charts that relate to all this. By the way, I should mention that I hope I'm coming through loud and clear. I've gotten some good feedback from some of you that my new Yeti, it's actually called Yeti. It's a Yeti microphone, is much better than what we had before. So I apologize for what we had before. Also, last time, some of the charts were bigger than usual because somebody asked me to make them bigger than usual. So I try to be accommodating here. And it turned out that it was a little bit off. So as I've said many times before, one of these days I'll get this all right and it'll be a flawless production. But right now it is what it is. So let's have a look here. Let's have a look here at figure 1. And this is exhibit 1 in this problem we're facing here with the supply and demand issue in the bond market. And you can see that the federal government budget deficit as a percent of nominal GDP, has typically been in the low single digit level. Then, of course, all of this is pandemic related, and arguably the early parts of the stimulus and the widening of the deficit were justified in an effort to avoid a true calamity, a depression, and so on. And it worked. But once a crisis hits, politicians just can't resist the urge to take advantage of it. And so the spending extravaganza continued. And look, I'm not blaming all this on the Biden administration. The Trump administration cut taxes, and that widened the deficit. So, I don't want to get into the politics of this whole thing or political about this whole thing, but let's just stick with the facts. And the facts are that we are seeing the federal deficit start to expand. And the projections are that it's going to continue to expand to be up in the high single digits as a percent of nominal GDP. And the question is, are we going to be able to finance it? We are going to be able to finance it. There's no question about that. The only question is at what interest rates, and will it be the kind of interest rates that, to use a term that was often used back in the 60s and 70s when people worried about the deficit, is will it crowd out the private sector and create problems in that regard in terms of higher interest rates? Well, here again, we are looking at expenditures and receipts through the second, this is through the second quarter, this is through the first quarter. I'm not quite sure why the chart's not doing both Q2, but we'll look at the actual deficit in a second. But you can see that expenditures, which is the red line relative to GDP, are starting to increase, and projections are they will continue to go up because of all the spending programs that were initiated in 2021. And then you can see that receipts, which were going up, are now trending lower. So that's the question here: is how's this tug of war between the supply and demand issue, which is fundamentally bearish? How does that play out with the inflation outlook, which from our perspective is bullish? But of course, that's a forecast. That's an opinion. It's not necessarily something that's widely shared. But I think if we continue to see good inflation numbers, that will be an offset to the supply and demand issue. The bond market, as we know, can be looked at as the 10-year yield, which is what we have here. And you can see that the 10-year yield has had a dramatic rebound here from this historic low of 0.5%. All the way up to, this morning it's over 4.3%. So for a while there, it looked like we were sort of consolidating, but now it looks like we're breaking out of this consolidation pattern. And underneath it all, the TIPS yield, you can see, has risen above this consolidation pattern, and it's running at 1.94%, which isn't a crazy level. I mean, back here before the financial crisis, we had the TIPS yield running around 2%. So this may very well be the new normal, or back to the old normal for the TIPS yield around 2%. And I've tried as much as I can to try to figure out some sort of model or some way to explain what drives the TIPS yield, but I'm hard pressed. If some of you have a good study on it or thought about it, let me know. It is what it is, but so I think we have to sort of look at it in its historical context. And this whole period here of 2008 until 2021 was a very abnormal kind of environment, with the reaction of the central bank to the financial crisis of 2008, and then the ongoing concern about not being able to get inflation back up to 2%, so keeping interest rates near zero. And then we had the pandemic environment. So if you take all this abnormality out, we're back to normal. And so what does that imply for the nominal bond yield? The math is pretty easy. The TIPS yield is 1.94%. And then the spread between the 10-year nominal yield and the TIPS yield, the real rate, as you can see, where did it go? Oh, I know. I've got it over here. Let's go over here to a different publication. See if that picks it up. Come on, you can do it. Oh, here we go. Okay. Then you can see this is what we were just looking at. I had to go to a different publication because I didn't show it in the morning briefing. But this is the spread between the 10-year tips, between the 10-year nominal and the 10-year tips. And here you can see this is what is widely viewed as a proxy for expected inflation. Again, I've been scratching my head about a model for tips, and this particular market expectations variable doesn't always line up with some other measures of expected inflation. But it's an identity. It's an arithmetic identity that the nominal yield can be disaggregated into the tips yield and this expected inflation. And the expected inflation proxy, let's call it that, has actually been coming down. So the question is, how do these things add up? Well, if this is going to be 2% and this is going to be 2.5%, then the 10 years should be 4.5%, which is possibly what we're crawling up to, 4.5%. It's interesting that we didn't just kind of blow straight up, once we kind of took out this October 24 high. But meanwhile, we continue to move higher. And on the other hand, it's conceivable that the inflation news will continue to moderate, and that this will be reflected in this expected inflation proxy. And maybe we'll be looking at something more like 2%, back to sort of a inflation environment that was something we had been experiencing before the pandemic. Again, 2% may sound awfully low relative to people's perceptions of not being able to get back down there. But as I just said, we're already under 3% when you look at the CPI shelter, and we know shelter is going to come down. I know energy prices are going to go up, and maybe some other price will go up ahead here. But on the other hand, the shelter inflation rate will be a moderating factor here. And we know that China is in a significant recession. We know that the import prices from China are contributing to some deflationary pressures in the U.S. So that may also be something to consider. So take 2%, and with 2%, you got a 4%. Anyways, we're talking about going back to normal bond yields. The normal bond yields prior to 2008, 2009 were more along 4 to 5%. And so that may very well be the range that we're going to be looking at. Question is, can the economy live with that? And the honest answer is, I don't know, but we're going to find out. But I think that the economy has proven remarkably resilient so far. Let's keep in mind that some of the increase in interest rates is actually benefiting the consumer. Consumer incomes are getting bolstered by higher income on interest. And then, of course, a lot of people refinance their mortgage at all-time lows, so that's not a real issue. But we do know that the commercial real estate market is going to be facing some real problems. So there certainly are rising bond yields increase the likelihood that we'll not only have defaults in certain areas of the credit markets, particularly commercial real estate loans, but we'll have more of them. Question is, what does Powell want to do about that when he speaks on Friday? Will he sort of repeat what John Williams has recently said? I think he might. I think it would be a prudent thing to do. I think he wants to calm down the bond market. I don't think he wants to. I think he'll say, look, if I think he's going to acknowledge that we've made progress in bringing inflation down. And I think he'll say that if it continues to moderate, if inflation continues to moderate, if we continue to make progress, then the Fed may very well have to consider lowering interest rates next year for the same reasons that John Williams has suggested. And I think that would help to calm the bond market down. If he doesn't do that and riles my friends, the bond vigilantes up quite a bit, and suddenly we're looking at the bond yield not only going up to 4.5%, 5%, I think it's going to peak out more at 4.5%, 4.75%, in my opinion. But if it kind of goes up to the Ackman level of, and he's talking about the 30-year, of 5.5%, I would think that as I said, creates a real problem for the economy on the default side. And I think it creates a problem for the stock market. At this point, I'm thinking that the market, the bull market, hit a peak for now on July 31st, right around 4,600. When we got there, I didn't raise my numbers for the end of the year. I kept it at 4,600. I'm thinking that this concerns about what's going on in the bond market may continue to weigh on the stock market, though not today. But it may very well continue to weigh on the stock market through September, which is a seasonally weak period in the market. And then I think a year-end rally on perception that inflation really is moderating, on maybe some more moderation in the hawkishness of the Fed. I think that could drive the market back up to something like 4,600. So we looked at that. This is the yield curve, and everybody's been kind of wondering, how is that yield curve going to go from inverted to flat to ascending again? And there are two scenarios for that. One is the historical one, is that the inverted yield curve correctly anticipated a financial crisis, which led to a credit crunch, which led to a recession. And that's when the Fed lowered interest rates, short-term rates, and that's when bond yields started to come down. Those short-term rates came down more quickly than bond yields, and that's how you went from inverted to flat to ascending. This time around, we have a unique situation. Again, a lot of people have been saying, this inverted yield curve has always been dead right in anticipating a recession. Well, it called the financial crisis quite well. We had the banking crisis in March. However, the Fed came in with a liquidity provision for the banks, and things stabilized pretty quickly. And the economy didn't have a credit crunch, and the economy has yet to have a recession. And so the other way that the yield curve can disinvert, kind of an awkward word, I guess some people call it uninvert, but we've chosen disinvert, is the way it's happening now. We're saying that the 10-year bond yield, this blue line, is increasing and may be increasing faster than the 2-year yield, because the 2-year yield is tied to the Fed funds rate and expectations of where the Fed funds rate's going. And so we could see a flattening of the yield curve with the 10-year currently 4.3% plus change, approaching where the 2-year is. But again, I think before that, we're going to have some more data. I think the labor market's still going to show signs of strength. I'm not expecting suddenly to see a recessionary scenario or something that validates the hard landing scenario. The piece this week on Monday today is called "No Hard Feelings," and basically I kind of review the hard landers' latest take, and for the most part, the most vocal hardlanders remain in that camp. And their concern now is that the economy is too strong, that inflation doesn't moderate, that the Fed has to continue to raise interest rates. And on top of all that, we've got this federal deficit issue. And these are smart people. They may have gotten this Godot recession wrong so far, but I continue to make sure that I'm aware of where they're coming from. In this debate that I've been having with the hard landers versus the camp I've been in, the soft landing, or now no landing for now. I still think that we're not going to get a recession between now and the end of next year, but I'm assessing that view very, very carefully as the data comes out. Well, covered a lot of territory here. I think the basic notion here is that we went from an environment where people were worrying about a recession, and that would be bad for the stock market, to one where the recession didn't arrive, and then all of a sudden we all figured out, well, wait a second, if we're not going to have a recession, and we've got a strong economy, and we've got a widening federal deficit. By the way, I completely should have gone there for, let's just go here. I wanted to just review the federal deficit for you here. So let's go to the website here, the handy dandy website, where everything is automatically updated. So let's go to money and credit. Let's go to U.S. Treasury. And again, we were just looking at the outlays and the receipts relative to nominal GDP. The story isn't any prettier. It's not relative in absolute terms. So here's the federal deficit. Everything looked pretty good, right? The economy's doing relatively well. Revenues are coming in, and then all of a sudden the damn thing's widening quite significantly. So we go from, basically a trillion to 2 trillion on a 12-month moving basis, and in just a few months. How did that happen? Well, here you can see that the Biden administration spending programs are starting to kick in. So outlays are starting to rise, and this is the 12-month sum of outlays. At the same time, what really kind of turned things around is that the receipts, which were booming, you can see there's sort of a trend here. This is a ratio scale. So there was sort of a trend here in receipts, and suddenly we're taking off well above that trend. Now we seem to be coming back down to it. So it's not that this is telling us that suddenly we're falling into recession. And this is, by the way, individual income receipts. Let's go a little further here. Isn't this fun when you can here we go. So look at this. This is individual income tax receipts. Absolutely soared about a year ago, and now all of a sudden it's coming back down to the planet Earth. And I think it's not that this is telling us that there's a recession and consumers suddenly aren't paying income taxes because they're unemployed or are not making as much. We know that's not the case. I think it really reflects the fact that we had the surge in tax receipts, and a lot of that probably, and the CBO in its latest report mentioned this, a lot of it was people panicking out of the stock market with substantial capital gains over the past several years. And that really boosted individual income tax receipts. So I think we had a little bit of aberration here that now is being reversed, and the result has been that the federal deficit is in fact widening. So with all that, let's see here. Okay. Let's go back here. Oh, I don't even know if I showed that to you. Anyways, like I said, one of these days I'll get this right. Why don't we go to the Q&A? So I got to change my glasses here. Somebody says here no sound. Nobody else is complaining about no sound, so you may want to just turn up your volume. I hope it's on your end, not my end. Okay, Michael, I talked with Ralph Acampora today. He sends his regards. Ralph thinks the correction is not over, but we get back to recent highs by end of year. Sentiment not too bullish to be a negative. Your take on how long the current pullback lasts? Yeah, Ralph and I have been sort of on the same wavelength. Back in October, we both turned bullish on the market. And I think Ralph was also looking for some level like around 4,600. Not quite sure about that, but we're still in sync. I think we're in a correction. If we go from the July 31st high down to the 200-day moving average of around 4150 on the S&P 500, that would be not quite a correction. It would be down 9.7%. And I think that's conceivable given the unsettled situation in the bond market and how that is weighing on valuation multiples. And then I think by year end, we get to 4,600. So we're in sync. Okay, Gus, a question on the risk with the yield curve. The BBB, the triple B spreads are behaving. So does this go against some of the concerns of disinflation? Also, this has followed a normal, nothing is normal these days, textbook consolidation that we normally get at this point of the year. I agree with you on the consolidation. As I just said, I think this is a seasonal correction, but it's not all technicals. These seasonals always seem to find something fundamental to drive them. And so the sell-off, I think, is being driven by what's going on in the bond market. With regards to the spreads of high yield to treasuries, it has been remarkably normal, suggesting that we're not going into a credit crunch situation, and that there's still liquidity out there, that people still are buying high yield securities, and that there isn't a fear that there's going to be a contagion of downgrades at least in the corporate market. The CRE market, the commercial real estate market, obviously is going to face lots of downgrades. And I think it's the reason that Moody's and Fitch have downgraded the banks, especially the small and regional banks, because they know that they're going to have defaults. Sadish. Hi, Dr. Ed. Is the bond sell-off thus far a U.S. or global phenomenon, given JGBs and German bonds have sold off similarly? As in, this is less about UST supply demand and the deficit. Well, it's a good point. It is a global phenomenon, and the bond markets are global. They're interrelated. There are plenty of investors that invest on a global basis. And so the rise in our bond yield has been reflected in bond yields going up in lots of other places in Europe, in Germany, and France. We're starting to see upward pressure on the JGBs. The yen has been very weak, and that heightens or fuels their inflation problem over there, puts pressure on them to raise interest rates. So all that's been coming together. And so it's a global phenomenon, but the bond market in the US probably calls the shots in many ways of which way we're going to go. And I think the fact that the bond market is still not convinced that inflation is moderating as I am, not as convinced as I am that the Fed should be done or will be done very shortly, with the bond market concerned about some of the hawks that are still squawking at the Fed. And on top of all that, the federal deficit and the compounding of the interest component of the federal deficit, it's all interrelated. Let's see, anonymous, doesn't higher interest rates mean more inflation versus less for many? Yeah, I mean, for those who have to borrow, it's a cost of money, and it is going up. For those who are getting interest, it's a source of income. But when we calculate CPI and PCED, you really don't see interest expense having much, if any, impact on those measures of inflation, and that's what everybody looks at. Oh, Chip, I'm sorry. Yeah, Chip says he's not seeing the charts. Can you share the screen? Okay, sorry about that, folks. Like I said, one of these days I'm going to get this all right. But what I was showing is that, as you heard in my commentary, is that the federal deficit's been widening over the past 6 months, largely because outlays have been expanding, reflecting the 2021 outlays legislated by Congress in the Biden administration's economic program. And the other variable that's changed quite dramatically is tax revenues, particularly individual income tax revenues, have narrowed dramatically because they were boosted last year by people panicking out of the stock market and having to pay capital gains taxes. So like I said, one of these days I'll get this all right. In the interim, I think I got my message across, and we had a good discussion with the Q&A. Have a good week, or try to have a good week. It's light on data, but it ends on Friday with, I guess Powell's speeches are always important. So I don't know that this is the most important speech he's ever given, but it's important. Thanks, everybody.